To another My Solo 401k Financial YouTube as well as LinkedIn webinar. We're going to get started momentarily. We're waiting for the viewers to join. It sounds like the audio is working as well, so we'll get started. Again, thank you for taking the time to join. First off, we would ask you to please like and subscribe. If you're not able to stay for the whole session, you can come back to our YouTube channel as the recording will be posted as soon as we're done. Please subscribe for more videos like this. If you have comments, you can go to our community and as we'll continue the discussion there. So again, if you're watching on a recording. So let's jump in. First off, we want to let you know that today, the focus of today's discussion is 2021 and 2022 Mega Backdoor Roth Solo 401k contributions. So we're going to have a deep dive discussion about those types of contributions, specifically for self-employed businesses that are taxed as a sole proprietorship, a single member LLC, or a 1099 NEC independent contractor. So we'll get started with some housekeeping and then we'll jump into the substance. So first off, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. We want to highlight some of our resources because we have tremendous resources for our community. So you can find our community at mysolo401k.net/mycommunity. And it's free to join. All are welcome. We have webinars every day where live Zoom calls essentially where you can come in, ask questions. You can see what other people are asking about. We have content that we present. So please engage and you can find the event schedule there, right there in the community. We also have a forum where you can post questions 24/7. You can see what other people are asking. You can post your own question. Just click create post. Again, it's free to join. All are welcome. And so that's another great way to engage. So with today's discussion, again, the focus is 2021 and 2022 Mega Backdoor Roth Solo 401k deep dive discussion, specifically geared for businesses that are taxed as a sole proprietorship, single member LLC, or 1099 independent contractor. As I mentioned, it's going to be a deep dive discussion. So we're going to talk about the contribution rules, the limits. We're going to go through a number of examples to see how those rules and limits work. We're going to take a look at our online calculator. We're also going to go through and talk about the mechanics, the deadline to make contributions, how to make contributions, how to report contributions. So again, sole proprietorships, LLCs, people who report their earned self-employment income on Schedule C of their 1040. So let's first talk about the benefits of a Mega Backdoor Roth Solo 401k. So with the Mega Backdoor Roth Solo 401k, you could potentially contribute up to $58,000 or $64,500 if you're 50 or older for 2021 to a Roth Solo 401k. For 2022, you could contribute as much as $61,000 or $67,500 if you're 50 or older. Of course, the benefits of a Roth Solo 401k is you have the potential for tax-free growth. Now, the prerequisite is that you have to be eligible to set up a solo 401k, and you have to have a solo 401k plan that allows you to make the Mega Backdoor Roth Solo 401k contributions. In other words, you have to find a Mega Backdoor Roth Solo 401k provider. To be eligible to set up any type of solo 401k, you need to be self-employed with no full-time W-2 employees working for any business owned by you or a spouse, if any. In terms of finding a Mega Backdoor Roth Solo 401k plan provider, you need to look for a plan that allows you to make voluntary after-tax contributions and then complete an in-service distribution by either moving the money from the voluntary after-tax sub-account to a Roth Solo 401k sub-account or a Roth IRA. Next, you want to look for a provider that will assist with establishing the required sub-accounts. As you see, as we go through these slides, you will need different sub-accounts, pre-tax, Roth, and as well as voluntary after-tax sub-accounts. Finally, you want to look for a provider that provides ongoing compliance support, specifically for the Mega Backdoor Roth Solo 401k. So for example, when you move the money from the after-tax Solo 401k sub-account to either the Roth Solo 401k or Roth IRA, that is a reportable event. It needs to be reported on a 1099-R. So we handle the 1099-R reporting as part of our service for no additional charge. We assist with establishing the required sub-accounts as part of the establishment process when you first sign up. And of course, we have a plan that allows for the voluntary after-tax contributions and in-service distributions. So the starting point in determining how much you can contribute to a solo 401k is recognizing that the ability to contribute to the plan is based on certain factors. Number one, your self-employment income, because you can't save more than you earn. Next, your age. If you're 50 or older, you're able to contribute additional amounts as a catch-up contribution. Another consideration is whether you participate in a retirement plan, such as a 401k plan through your day job. Finally, the type of contribution that you're looking to make. As you will see as we go through the rules, there are different sublimits for different types of contributions. It could be employee versus employer, pre-tax, Roth, and or voluntary after-tax. So again, the starting point is your self-employment income. You have to have the self-employment income to justify the contribution. So when your business is taxed as a sole proprietorship, a single member LLC, or a 1099 independent contractor, your ability to make solo 401k contributions is based on the net income that you report on Schedule C, less 1/2 of the self-employment tax. So you can't consider W-2 wages, for example, from your day job. You can't make contributions based off of investment income either. So for example, income that's reported on Schedule E of your 1040. So step one is to calculate the self-employment compensation. Again, that's the net income, which is on line 31 of Schedule C, right after you've reduced your gross income by your business expenses, less 1/2 of the self-employment tax. So you need to run this pre-calculation. Now our online calculator will run this pre-calculation for you. It'll determine what is 1/2 of self-employment tax. Next, you need to determine the contribution year for which you want to make contributions. So the overall limit increased from 2021 to 2022. For 2021, the overall limit is $58,000. It increased to $61,000 for 2022, plus an additional $6,500 if you're 50 or older that you can contribute each year as a catch-up contribution. Next, you need to determine the type of contribution that you want to make. So in the words of the IRS, you're both the employee as well as the employer. So you can make both employee as well as employer contributions. So if you have a plan like ours that allows it, you can make employee contributions as pre-tax, Roth, or voluntary after-tax contributions. You can also make employer contributions. Employer contributions are always pre-tax contributions. So keep in mind that, and we'll see as we go through the rules, that The employee limit applies at the employee level. So if you make contributions to another plan, like a day job plan, that'll reduce how much you can contribute to the solo 401k as an employee contribution. But the employer limit is not impacted by contributions made to a day job plan. Likewise, the voluntary after-tax contribution limit is not impacted by contributions made to another plan. So next, let's dive in and really take a deep dive look at the different sub-limits. So first off, we're going to start with pre-tax employee contributions. So employee contributions are also referred to as salary deferrals. You can contribute 100% of your self-employment compensation, dollar for dollar, up to $19,000 for 2021 or $20,500 for 2022, plus an additional $6,500 catch-up contribution if you're 50 or older as a pre-tax employee contribution. Now this employee limit applies at the employee level. So if you have a W-2 job, you have a 401k plan through your W-2 job, and then you also have a side business for which you have a solo 401k, if you make contributions to your W-2 daytime employer-sponsored 401k plan, you need to reduce how much you can contribute to the solo 401k as an employee contribution, unless the other plan is a 458 governmental plan, in which case contributions are not aggregated. So this employee contribution, if the plan allows it, like ours does, can also be made as a Roth contribution. So you could do 100% as a pre-tax, you could do 100% as a Roth, or you can do a mixture, some as pre-tax, some as Roth. If you're going to make Roth contributions, those contributions need to be deposited into a separate sub-account for each participant. So next, we'll take a look at the employer contribution limit. Employer contributions are also referred to as profit-sharing contributions. So for a business that's taxed as a sole proprietorship, a single member LLC, or a 1099 independent contractor, where you're reporting your earned income on Schedule C of your 1040, your ability to make employer profit-sharing contributions is equal to 20% of your self-employment compensation. Remember that self-employment compensation is equal to line 31 of Schedule C, less 1/2 of the self-employment tax. Also keep in mind that the total amount of contributions that you make to the solo 401k, employee, employer, voluntary after-tax contributions can't exceed the overall limit, which is $58,000 for 2021 or $61,000 for 2022, plus an additional $6,500 if you're 50 or older. Now, any contributions that you make to another plan through an unrelated employer, like a day job plan, will not reduce how much you can contribute to the solo 401k as an employer contribution, because the employer contribution limit applies at the employer level. Now, the one exception to this general rule is contributions made to a 403b, so the 403b exception. If contributions are made by you or on your behalf to a 403b, you need to aggregate those contributions with the contributions made to the solo 401k to confirm that the total contributions don't exceed the overall limit. Finally, we're going to take a look at the voluntary after-tax rules. Then we're going to turn to the scenarios and examples to see how this works. So voluntary after-tax contributions are how one makes Mega Backdoor Roth contributions. Because as you'll see here, the limit is higher than the Roth solo 401k contribution limit. If you remember with a couple slides back, the Roth solo 401k contribution limit is the employee limit, 100% of the self-employment compensation up to $19,500 or $20,500 for 2022, which can be made as a Roth solo 401k contribution limit. The voluntary after-tax contribution limit is 100% of the self-employment compensation, dollar for dollar, up to the overall limit, $58,000 for 2021 or $61,000 for 2022. Now, you do need to reduce how much you can contribute to as a voluntary after-tax solo 401k contribution by any other employee or employer contributions made to the solo 401k. You don't need to reduce it, how much you can contribute to as a voluntary after-tax solo 401k contribution by contributions made to another retirement plan through an unrelated employer, like a day job 401k plan, unless the other plan is a 403b. If you do make voluntary after-tax contributions, they do need to be deposited into a separate sub-account for each participant. So it's similar to the Roth contributions, where those also need to be deposited into a separate sub-account for each participant. This is how someone might have 3 different sub-accounts: a pre-tax, a Roth, and a voluntary after-tax, or even 6 if, say, both the husband and wife are both participating in the solo 401k. When we get to the later slides and we go through the illustrations, we'll be able to visualize that. Now, please note that the voluntary after-tax contribution limit doesn't go up if you're 50 or older. But at the same time, you don't have to reduce what you contribute to the solo 401k as a voluntary after-tax contribution by those catch-up contributions made to the plan. So ultimately, you can still get to the same place. You could still ultimately contribute up to $64,500 for 2021 or $67,500 for 2022, but you would just make that catch-up contribution as an employee contribution, not as a voluntary after-tax contribution. So now we're going to go through our scenarios and examples to see how these rules work. So what we will do is we will set a baseline scenario. We'll define the baseline scenario, see how that works, and then we'll tweak the different elements to see how that impacts how much we can contribute. So our baseline scenario is a self-employed business taxed as a sole proprietorship, a single member LLC, a 1099 independent contractor, where the income is reported on Schedule C of your 1040. In our baseline scenario, there's one participant who's under 50 years of age, who does not make contributions to another plan, and whose goal is to maximize pre-tax and then make any additional contributions as either a Roth or voluntary after-tax contribution. We will also assume that this person has $100,000 of self-employment compensation. In other words, on line 31 of Schedule C, less 1/2 of the self-employment tax. So in our baseline scenario, this person is able to contribute $19,500 for 2021 as a pre-tax employee contribution, or $20,500 for 2022 as a pre-tax employee contribution. Because remember, the limit is 100% of the self-employment compensation up to $19,500 for 2021 or $20,500 for 2022. Next, this person would contribute $20,000 as an employer pre-tax contribution. Because remember that the limit is 20% of the self-employment compensation. And then they could contribute additional amounts as a voluntary after-tax contribution up to that overall limit. So another $18,500 for 2021 or $20,500 for 2022. Because again, the voluntary after-tax contribution limit is 100% of the self-employment compensation, dollar for dollar, up to the overall limit, but reduced by any other employee or employer contributions that are made to the plan. So now we're going to go back to the base, and we're going to assume, though, that this person, instead of having $100,000 of self-employment compensation, we'll assume that they have $50,000 of self-employment compensation. So what changes? So they can still contribute the same amount as a pre-tax employee contribution, but now they're going to be able to contribute less as an employer pre-tax contribution. because the limit is 20% of the self-employment compensation. So now it's 20% of a lower number. 20% of 50,000 is 10,000. And then they'll be able to contribute the difference, but the difference up to 50,000, because remember, you can't save more than you earn. And the voluntary after-tax contribution limit is the lesser of 50,000 or the overall limit, which is always going to be 50. So that means they'd be able to contribute $20,500 for 2021 as a voluntary after-tax contribution and $19,500 for 2022. And then they could move the money over to their Roth solo 401k sub-account or Roth IRA. So we're going to go back to the base. So $100,000 is self-employment compensation. But now let's assume that the person maximizes the employee contributions to their day job plan. So what changes, if anything? Well, they're not going to be able to make any employee contributions to the solo 401k because the employee limit applies at the employee level, and they already hit the limit on their day job plan. They'll still be able to make the employer contributions because that employer limit applies at the employer level and is not impacted by contributions made to the day job plan. Likewise, the voluntary after-tax limit is not impacted by contributions made to the day job plan. So they're going to be able to now contribute the difference between 20 and the overall limit, 38,000 for 2021, 41,000 for 2022, as a voluntary after-tax contribution, and then be able to move the funds over to either the Roth solo 401k or Roth IRA. So now let's go back to the base. The person does not make contributions to another plan, but their goal is to only maximize Roth and or voluntary after-tax contributions. So here, this person, instead of making the employee contribution as a pre-tax contribution, they would deposit the money into a Roth solo 401k sub-account. They would skip the employer contributions because employer contributions are always pre-tax contributions, and then just make the difference up to the overall limit, $38,500 for 2021, $40,500 for 2022 as a voluntary after-tax contribution. And then they could move the money over to their Roth solo 401k. So at the end of the day, they would have $58,000 in their Roth solo 401k for 2021 and $61,000 in their Roth solo 401k for 2022. So now let's go back to the base, back to making the 100,000. Goal is to make first pre-tax and then Roth and or voluntary after-tax. But the difference here is that there's two participants. Let's say it's a husband and wife that are both participating in the plan. Right? They could both be, say, realtors working in the same business, both reporting the same amount of earned self-employment compensation and both with the same scenario. So what changes, if anything? Nothing changes in terms of the amounts. This scenario here just illustrates that the ability to contribute to the plan is based off of each person's situation, each participant's age, each participant's earned self-employment compensation, etc. So since each participant's in the same situation, each participant is contributing the same amount. So now let's go back to the base, but now let's assume that the individual is 50 or older years of age. So what changes, if anything? Well, nothing changes in terms of the amounts other than now the person is able to make an additional $6,500 catch-up contribution. So this scenario illustrates that that catch-up contribution is made as an employee contribution and not as a voluntary after-tax contribution. Because remember, the voluntary after-tax contribution limit doesn't go up when you're 50 or older, but you also don't have to reduce what you can make as the voluntary after-tax contribution by the catch-up contributions made to the plan. So you end up in the same place in terms of how much you contribute as a voluntary after-tax contribution. So now let's go back to the base. Goal is to maximize Roth and or voluntary after-tax, and this person is maximize contributions to their day job plan. What changes? Well, they're not going to be able to make any employee contributions because they already hit the limit under their day job plan. They're not interested in making employer contributions because employer contributions are always pre-tax contributions. So they make the entire contribution, $58,000 for 2021, $61,000 for 2022 as a voluntary after-tax contribution. So let's go back to the base. This time, essentially the same scenario, but the person's 50 or older, but they're still maximizing employee contributions to their day job plan. So as you can see, nothing changes. They still can't make employee. They still don't want to make employer. They make the entire amount as a voluntary after-tax contribution. So now let's add on that there's a second participant, but in the same boat, right? Same self-employment compensation, already maximize contributions to the day job plan, same goal to maximize Roth and or voluntary after tax. So this again illustrates that the amounts don't change, but the slide and the scenario illustrates how the ability to contribute to the plan is based off of each person's situation. And since each participant here has the same situation, they're each contributing the same amount. So that takes us to the end of the scenarios. So we now want to highlight our online calculator. So you can easily find it on our website, mysolo401k.net. There's a drop-down menu under Learn. You can click on Online Tools, click through to the calculator. So when your business is taxed as a sole proprietorship, a single member LLC, or a 1099 miscellaneous or NEC independent contractor, you will choose unincorporated sole proprietorship as your business type. For the net income, you will enter the amount from line 31 of Schedule C. Next, you'll enter the age of each participant as of the end of the applicable year. You'll be able to view the report, click on the detail, print a copy for your records. Now note that the calculator doesn't contemplate a scenario where someone is making contributions to a day job plan. It also doesn't contemplate a scenario where someone's making after-tax contributions. So you'd have to modify for those scenarios. Once you know how much you can contribute, how much you want to contribute, it's time to make the contribution. So we want to talk about it in detail in terms of the mechanics. So first off, how do I make contributions? You can make the contribution by check. You can make the contribution electronically. Either is acceptable from a solo 401k perspective. To make the contribution by check, simply write the check payable in the name of the solo 401k and write annual contribution on the memo section of the check. For electronic transfer, you want to check with the financial institution that holds the accounts. So as part of our onboarding process, we're helping our clients establish accounts at banks, at brokerages. We have clients at hundreds of different banks, many different brokerages. The general rule for the brokerages is that they won't allow you to deposit a contribution electronically from a third-party account, an external account, where the name on the external account doesn't match the name on the account at the brokerage, i.e. the name on the external account is not in the name of the plan. The one exception to this rule is Fidelity, where they will allow you to make an electronic deposit from an external account where the name on the external account is not in the name of the plan. If you have more than one participant, each participant deposits his or her contributions into separate sub-accounts. If, like in the Mega Backdoor Roth solo 401k contribution scenario, you have different types of funds that are being deposited, pre-tax, Roth, and or voluntary after-tax, you'll need separate sub-accounts for each type. You can make the contribution in one lump sum or a series of contributions. You can make the contribution from a personal account or a business account. Either is acceptable from a solo 401k perspective. The deadline to make the contributions is your business tax return deadline, including any timely filed extension. And this is clear based on IRS publication 560, which is the landmark guidance for solo 401k and other retirement plans for self-employed individuals. There's a chart on page 3 of that publication, which we have a snippet here on this slide, which makes it crystal clear that as long as the plan is set up by the end of the tax year, that would have preserved the right to make all types of contributions, employee, employer, voluntary after-tax contributions, up until the business tax return deadline, including any timely filed extension. So when your business is taxed as a sole proprietorship, a single member LLC, an independent contractor, and you're reporting that income on your 1040, effectively your 1040 is your business tax return. So the deadline is going to be for 2021, April 15th or October 17th of 2022 if you file a timely extension. For 2022, for plans that are set up by the end of the year, i.e. you sign up with us by December 31st, 2022, you would have preserved the right to make 2022 solo 401k contributions, all types, employee, employer, and voluntary after tax, anytime up until April 17th of 2023 or April 16th of 2023 if you file a timely extension. This, of course, is for self-employed businesses where you're reporting that earned self-employment compensation on your 1040, such that the 1040 is effectively your business tax return. Next, let's take a look at how you report solo 401k contributions. So the answer depends on the type of contribution that you're looking to make. If it's a pre-tax employee or a pre-tax employer, those contributions are reported on line 16 of Schedule 1 of the 1040. If it's a Roth contribution or a voluntary after-tax contribution, those contributions are not reportable when your business and your earned self-employment income is listed on your Schedule C of your 1040 because you're a sole proprietorship, a single member LLC, or an independent contractor. Now, I will note that voluntary after-tax contributions are indirectly reported in that the subsequent transfer from the voluntary after-tax account to either the Roth solo 401k or Roth IRA is reportable on a 1099-R. So the deposit into the voluntary after-tax sub-account, the contribution, again, is not reportable, but the subsequent transfer is reportable. And we'll talk about that more in a couple slides from now. So that takes us to the next set of slides, which again, we want to focus on Mega Backdoor Roth. So Mega Backdoor Roth, again, is where you're making voluntary after-tax contributions into a separate voluntary after-tax sub-account and then transferring over to a Roth solo 401k or Roth IRA. So we want to highlight and confirm that that subsequent transfer can be transferred by check or by electronic transfer. You can go between bank or brokerage. Again, you could go to either a Roth solo 401k or Roth IRA. As I mentioned earlier, we have a lot of individuals, a lot of clients who have us help them open accounts at different brokerages. So we wanted to take a few slides to highlight the process at the brokerages. So for example, Schwab is a very popular option. So as part of the onboarding process, we're going to ask you, how many accounts do you want, right? Are you looking to make pre-tax, Roth, after-tax? Is it multiple participants? So we can prepare the requisite number of accounts. We can prepare the paperwork to open the requisite number of accounts. So let's say you direct us to prepare the paperwork to open brokerage accounts at Schwab. We would pre-fill the paperwork so the account could be open at Schwab. Once the account is open at Schwab for the voluntary after-tax contributions, you would make that contribution within the limits, by the deadline, etc. You could then convert the funds from the voluntary after-tax sub-account to either a Roth solo 401k sub-account, which could be another brokerage account at Schwab, or to a Roth IRA. That could be a Roth IRA at Schwab or even a Roth IRA at another institution. Finally, you need to let us know about that conversion. So we have an online form where clients can submit information 24/7 to let us know about conversions. So that gives us the information that we need to capture in order to prepare the 1099-R. So as I mentioned, the move from the after-tax account to either the Roth Solo 401k or Roth IRA is reportable on the 1099-R. If you go to our website, mysolo401k.net, and then in the upper right, click on Forms, you'll see that we have both a voluntary after-tax to Roth Solo 401k form, as well as after-tax Solo 401k to Roth IRA form. Again, it just takes a couple minutes to fill that out. That'll get your plan in the queue for us to prepare that 1099-R, which we handle as part of our service for no additional charge. Now, another popular option is Fidelity. It's going to be a very similar process. I mean, you'll just tell us you want to have the accounts at Fidelity. We prepare the paperwork to open up the free brokerage accounts at Fidelity. You make the contribution, you move either to a Roth Solo 401k sub-account or a Roth IRA, and then you tell us about the transfer by submitting that online form. Likewise with TD Ameritrade, again, very similar process. Open the account at TD, make the contribution, convert to either Roth Solo 401k or Roth IRA, and then submit the form. Now, a common question is, should I convert to Roth IRA or Roth Solo 401k? And there's no right or wrong answer. There's different considerations based on your situation. In terms of moving to a Roth Solo 401k, some of the reasons that individuals might want to do that is because in addition to making Mega Backdoor Roth Solo 401k contributions, which is a very common reason that clients are signing up with us, another very common reason is the ability to invest in alternative investments, whether that's cryptocurrency, real estate, notes, precious metals, etc. So by keeping the funds in the 401k, by converting to the Roth Solo 401k, you're still going to have direct checkbook control. You're still going to be able to invest those funds in those alternative investments. Another reason is that you could later, if you wanted to, take a loan, borrow that money, and then use it for whatever purpose you want. So with our Solo 401k plan, it allows for Solo 401k loans, and we prepare the required loan documents as part of our service for no additional charge. In contrast, an IRA, including a Roth IRA, don't allow for loans. There's no such thing as being able to take a loan from an IRA. Once you move the money to that Roth IRA, you're not going to be able to take a 401k loan. Also, when it comes to alternative investments, it's going to be harder. If you want to be able to have direct checkbook control over the funds in the Roth IRA to be able to invest in alternative investments, you'd have to set up an LLC underneath that Roth IRA. Now, one reason that people will want to move money over to the Roth IRA as opposed to the Solo 401k is that Roth IRAs are not subject to required minimum distributions. Now, I do note that individuals might first transfer to the Roth Solo 401k, and then once they're approaching the RMD age, will then just transfer the money over from the Roth Solo 401k to the Roth IRA to zero out that Roth Solo 401k so that there's no RMD that applies. So there's no deadline to convert. We talked about how there's a deadline to make contributions, the business tax return deadline, including any timely filed extension. But the subsequent conversion from the after-tax account to the Roth Solo 401k or Roth IRA, there's no deadline. It's also noteworthy that the conversion is reportable, and it's reportable for the year of the conversion. So you might be making 2021 voluntary after-tax contributions in 2022, as late as April 15th of 2022 or October 17th of 2022 if you file an extension. Of course, that means the conversion wouldn't be until 2022. So the conversion is going to be reportable on a 2022 1099-R that would be issued in 2023. And there's no problem with the fact that the deposit was initially for 2021, but it's not actually reported until 2022. In terms of what is reported on the 1099-R, it's the amount converted. So that would be, of course, the amount contributed plus any subsequent gains. Now, typically, or often at least, I should say, there is little to no gains because the money is just held in cash and then moved over in cash to the Roth solo 401k or Roth IRA. Again, the 1099-R is issued for the year of the conversion. The amount that's reported on the 1099-R would also be listed on line 5A. So you list the amount converted on line 5A and any gains on line 5B. But again, oftentimes there's little to no gains because it was just cash that was deposited. It wasn't invested in the after-tax account before it was moved over to the Roth solo 401k or Roth IRA. As I've mentioned multiple times, we prepare the 1099-R as part of our service for no additional charge. You just need to let us know by submitting our online form to provide us the information so we can get your plan in the queue. So now let's take a look at some illustrations to help demonstrate how the account setup might look. So in this illustration, we have one participant who has pre-tax, Roth, and/or voluntary after-tax funds. So this person has three different accounts. One account in the name of the plan for pre-tax funds, a second for Roth, and then that third account for voluntary after-tax funds. Our next illustration, we have two participants, right? Let's say it's the husband and wife realtors, right? Where they're both making Mega Backdoor Roth contributions. So in that case, there's six accounts. There's pre-tax, Roth, and after-tax accounts for the husband, pre-tax, Roth, and after-tax accounts for the wife, each set in the name of the plan for the benefit of that participant. That's how you end up with six. Here we have a scenario where the person doesn't want to convert to a Roth 401k, but Roth IRA. So if this individual is not going to have Roth solo 401k funds, they would really just need two accounts for the solo 401k. Because let's say they rolled over some pre-tax funds from a former employer plan. So they have those funds go into an account in the name of the plan for their benefit for pre-tax funds, a second account in the name of the plan for their benefit for after-tax funds, and then can just convert the after-tax over to the Roth IRA. So it goes out of the plan over to a third account, but that third account is a Roth IRA, so it's not in the name of the plan. So that takes us to the end of the slides we wanted to share. Thank you so much. We can continue the conversation, and we will on our community, where we have forums, we have webinars every day of the week where you can join. It's free to join. All are welcome. You can post questions, like I mentioned. It's simply mysolo401k.net/mycommunity. You can also email us at business@mysolo401k.net or call 1-800-489-7571. We would ask you to please like and subscribe. Thank you so much. Please also join the community if you're not already a member. So we do have some questions here. Thank you so much for the participation. Any tips on getting 100% of W-2 wages into an after-tax contribution? For example, if we have $100,000 left of wages to pay and want it all after-tax, can the employee owner pay the FICA out of pocket? Yes. So the ability to make contributions, making contributions to a solo 401k doesn't reduce the obligation to pay FICA. But you could separately pay that so that you can contribute 100% as a solo 401k contribution, whether you make it as an after-tax or a different type of contribution. Now, of course, you are asking about, it appears a self-employed business taxed as an S corp, or maybe you're receiving W-2 wages from that S corp, because of course you can't make contributions based on W-2 wages from your day job. So we do have a whole set of presentations we did already specifically for S corporations. So if you go to our website, for example, we have them all organized on our guides page, which is here. You can see that we have, it's organized by business type, by type of contribution, etc. So let me chat over that link. You can just search for the word guides, and it's the third result. So guides, scroll down, it's right here, it's number 3. Yes, exactly. So you'd want to check out that page, or that then you can access the slides, the videos, etc. Thank you so much for the participation. Great question. Next question. If I'm contributing to the voluntary after-tax sub-account in my solo 401k next month as a 2021 contribution, how do I officially document that the contribution is for 2021, not 2022? So as we saw in the slides, if your business is taxed as a sole proprietorship, single member LLC, 1099 independent contractor, where you're reporting that earned self-employment income on Schedule C of your 1040, the contribution is not reportable. It doesn't apply. You only report pre-tax contributions, pre-tax employee or pre-tax employer. Now, when you later move it from the voluntary after-tax contribution to either the Roth solo 401k or Roth IRA, that subsequent conversion is reportable on a 1099-R. And of course, you would note in your plan records that that was a 2021 contribution, but it's otherwise not reportable. What needs to be done if I set up my account as a single member LLC, taxed as a sole prop, but then switch to an S corp down the road? Well, you would need to contact the plan provider to let them know about the change so that they can update the plan documents accordingly. And then, of course, your ability to contribute to the plan is going to be based off of the W-2 wages from the S corp. But other than that, I mean, you wouldn't need to update the accounts, investments, etc. It would really be a document update. Thank you so much for all the participation. Again, we encourage you to participate in our community, to like and subscribe, and thank you so much. Appreciate it. Looks like that takes us to the end of the questions. I don't see any more questions, so thank you so much. Take care.